Welcome to Cherry Street Investor Education with Kavita Baratake, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals. Here's your host, Kavita Baratake.
Good evening, everyone, and thanks for joining in today. Today we are going to talk about beyond stocks, retirement investing into real estate. So where I want to start here is most employed investors. So I was one of them 20 years ago, I guess. Actually, not that long ago, 2019, I quit my job in tech. I was in tech for 20 years. And most of us end up having our entire retirement accounts into stocks because that's what traditionally the stock market, that's what most of our 401k employers, 401ks are designed to do, right? Like we just invest the entire 100% of the 401k into stocks. And when I started becoming a real estate investor, actually learning about the fact that, hey, I could do something different with my 401k other than just investing into retirement, investing into the stock market, I think I had like an aha moment, thinking that my thought was whatever cash I had, I could put into real estate, but I didn't think I could actually use my retirement account for real estate. So it was like an aha moment for me. And I know a lot of you guys here are pretty savvy. You already know this, mainly because I think this information is more prevalent now and versus 8 years ago when I started learning about all this. So anyway, today we're going to talk about how and why you should consider this strategy for diversifying your retirement accounts into everything other than just stock market, because stock market returns have been great the last year, but we don't know how long this is going to last. And also it's a lot volatile. As you get older, you want to shift your assets a little bit into a little more stable. And I think real estate is a lot more stable than stock market. And I think most people would agree to that. So anyway, today, I'm excited to host Ilana Brown and Restrepo from Nabers Solo 401k. And they're going to talk about how you can use your retirement account to invest into real estate and alternative assets like crypto, precious metals, and much more. This webinar will be a lot of content, but cover some key points like what is a solo 401k and why is it so powerful? How are solo 401k accounts different from IRAs? What are some of the pros and cons? A lot of you folks have heard about IRAs. Yes, you can also invest your IRA into real estate and other assets, but there's something called a self-directed IRA. And some of you might not be familiar with that. We also talk about traditional versus Roth solo 401k, understanding prohibited transactions, what's UBIT and UDFI. I had some investors trip up on this because we're getting close to selling properties right now. And they just had this moment that, oh, I have to pay taxes on my retirement account. I didn't know about that. So anyway, I don't want you guys to be caught unawares when you're using a retirement account. So you know how to structure it right from the get-go and not have any surprises later. And also we talk about different investment opportunities, including some examples on how you can use this retirement account. So with that, I want to talk a little bit about a quick disclaimer here. We always, in this whole webinar series that I do, I always get awesome guest speakers to come present educational content. But I have to tell you, always consult your own attorney, financial advisor, and CPA, and of course, Nabers is here to help you set up a solo 401k and they can give you some advice. But as far as what your CPA says, that should be your tax advice, not us, not them. Just a few housekeeping items. If you have any questions, please type them in the Q&A box and not the chat box because it kind of scrolls by really quick. I like to keep track of your questions. And also, I always record webinars and everything is link is sent out to the registered attendees within 24 hours. If you want to avoid it from going to spam or promotions, please add my email so you can get it in your inbox. I've had a lot of people ask me that after every webinar. So a little bit about what I do. I help people invest passively in real estate. I'm also a real estate agent. I help people find multifamily and other investment properties. Besides that, I'm also a life insurance broker, so I wear a lot of hats. The reason for all this is you can use life insurance policies to actually invest passively into real estate. So that's the long story of it. And I focus a lot on education. So if you have want to catch up on some of our previous webinars and education, I have a whole channel on YouTube dedicated to this. And if you would like to review this webinar today, you can go subscribe on the channel and you'll be notified as soon as I upload any content to this channel. Besides the webinars, I also do a lot of short videos and other content so people can learn about little things related to investing. So some upcoming webinars next week, just to follow along with the retirement planning, is tax planning for passive investors. A lot of people don't know what goes on in a passive investment like a syndication. So we'll talk about what the tax implications are when you buy a property or in a syndication, also when you sell a property or dispose of property. We'll also talk about premium financing with life insurance. Life insurance is a great way for you to grow money tax-free. And not a lot of people know about these strategies. So I want to talk a little bit about, we'll have a guest speaker coming and talking about that. Also talk about residential mortgage and financing options. I know a lot of you have gone through refinancing and all of that stuff, but what happens if you're self-employed? What are some of the options? So if you have any topic suggestions, please feel free to send them to me. I take it seriously. I'll go hunt for a good guest speaker to come present this. Also, I'm excited to present Passive Investor at 2021. It's our virtual conference. It's 2 days. It's November 6th and 7th. I hosted to two of my partners, Raj and Ramesh. This year, we are featuring more than 15 high-profile real estate investors, attorneys, as well as tax CPAs. We are doing a wide range of topics this year, from investing in the post-COVID world, build-to-rent communities, land development, new builds, talking about renewable energy, legal structures and documents in a syndication, and the whole shebang. So don't miss out on this unique event. It's basically only for passive investors. Of course, if you're an active investor, you're welcome to attend. Most active investors also end up being passive investors because we want to always generate passive income, right? So you can buy your early bird tickets at passiveinvestored.com for this event. And I also have a Facebook investor group if you're interested in joining, called Purely Passive Investor Group. All right. A little bit about me, I'll make it really short. A lot of you folks join my calls week on week, so you guys know me. A lot of you guys watch the videos and the webinars on YouTube. So I come from Bangalore, India. I've been here since '98. My background is tech. I was in tech for 20 years, retired myself thanks to real estate, and here I am talking about real estate and everything related. So I started Cherry Street Investments with the simple goal that it took me a long time to learn these things. I hope to shorten that path for a lot of you folks on the call today. And with that, I'm going to hand it to Eric and Ilana. Thank you guys for being here. I appreciate your time, and I'm looking forward to learning from you guys.
And thank you for all that. And thank you for all the education you're putting out. I mean, you've done some unbelievable things. So awesome.
Thank you so much. I'll stop sharing and let you guys share now.
Okay, so we're going to talk about how to invest retirement funds into real estate and some other things. Quick disclaimer for us as well. We are the IRS plan document providers. So we provide you with a plan. We are not your replacement for CPAs or for legal advice. So always double check with your attorneys or accountants. So real estate. Real estate has been popular for a very, very long time. You know, self-directed investors like real estate because it's a tangible asset. You know, with stock market, it's not tangible. We don't know what's going to happen. So it produces a high yields. It's an appreciating asset, and it can protect against inflation. So checkbook control. So we are going to talk about today the importance and the power of controlling your own funds. All of our plans that we do here at solo401k.com and Nabers Group are full checkbook control. So we'll cover how this all works. Also, if anyone wants to sign up for a one-on-one consultation, we'll give you our information at the end of this slideshow as well. A little bit about us. So we launched the IRA LLC in 2003 and then solo401k.com in 2006. We've been working with the IRS for 15 years, and we've helped thousands and thousands and thousands of investors take control of their funds. What's really awesome is that all of us at Nabers Group, we all have our own checkbook control plans. So we've been through the process. We know how it goes, and it just makes it much easier to share our experience. So just so you know, this is real. A lot of people that me and Eric talk to so many people all day long, and we always hear like, what is this? How does this exist? I can't believe I don't know about it. And it's not your fault, you know? It's just not that popular. People don't educate enough about it. Accountants don't know about it. So you're not alone, but it does exist. Here is the proof on the IRS website. And then it's always really important to check that your provider really exists. So you can see Nabers Services LLC, that is right on the IRS website. So we specialize in checkbook control plans. You are completely in charge of your funds. We never see your funds. And we'll talk a little bit more about this. So possible investments. You can do all kinds of different real estate. Of course, syndications is a great one. You can do commercial properties, private equities, tax liens, tax deeds, REITs, and then so much more. Bitcoin, cryptocurrencies, you know, you can still do stocks, bonds, ETFs. We're not saying that the stock market's bad. We're just opening up, you know, your options here. Precious metals, private placements, crowdfunding, and just so much more. So this is kind of what it looks like. So we'll establish your account, and we're going to help you every single step of the way. Then you're going to fund your account. We help you with your rollovers. We make it very easy on you. You're going to make contributions. As soon as you do that, you're going to choose your deals, whether it's real estate, precious metals, cryptocurrency, whatever it is, and then you're going to invest. You're simply just going to, you know, wire funds to maybe a syndication deal. And always what's really important is that your retirement account is always the investor on any of your deals.
So with that, yeah, we'll dive deeper into the Solo 401k, which is one of the main vehicles that we offer here at the Nabers Group. So the Solo 401k, it's basically a company retirement plan. So also known as a qualified retirement plan or employer-sponsored plan. It has to have a sponsoring business. So, you know, it's really designed for those small businesses. We'll get into what kinds of businesses those are, but they can be pretty wide, pretty varied. So what do you need to do to qualify for that? Basically, you have to have the presence of some form of self-employment activity, right? So some self-employment income. And the other piece is you have to have the absence of any full-time W-2 employees in your business outside of yourself or your spouse, right? As long as your employees work less than 1,000 hours and you have that self-employment activity, then you certainly will qualify. Now, again, like I said, it doesn't matter what kind of business structure you have. You could have a sole proprietorship, single member LLC, multi-member LLC, S Corp, C Corp. You could be doing business as, you could have a partnership. Really, it doesn't matter. It just has to be some form of self-employment activity. So basically, what does that mean, right? Working full-time is great if you're working full-time in your business. Or if you're still working part-time, you have maybe that W-2 job like Kavita had where she was, still as an employee, but then she also had her side hustle on the other side. It's okay to have both. You can have either one. You could be working full-time or you could be working part-time. Either one works. So yeah, like I said, it's okay to have that normal job. That day job is great. Maybe that helps you fund it, right? But basically, yeah, you have to have that side hustle or something on the side. It could be 1099 income. It could be any kind of self-employment activity whatsoever. any kind of business really qualifies, honestly. Just get creative. You know, realtors, attorneys, CPAs, software developers. The list really is pretty endless as far as what qualifies. There's a lot of people working now that are, you know, maybe companies have transitioned you from a W-2 to a 1099. That's totally qualifying as well. Maybe you're a writer, maybe you're an Amazon reseller. You know, even if you're just driving Uber or Lyft on the side, or you have a small side business, even if you're just earning, you know, some 1099 income, it doesn't have to be a lot, right? It could be a few $1,000s. That's enough to qualify you for a solo 401k.
So let's talk about how you fund your solo 401k. So there are two ways, either with rollovers from another retirement plan or new contributions from your business earnings. So rollovers, almost any rollover, any retirement plan rolls into this. Traditional IRAs, other 401ks, 403bs, TSP, 457, pension plans. What's important to know is that a Roth IRA does not roll into this. Usually there's not a taxable event, and we walk you through the whole rollover process. It's very easy. So as you can see, you're rolling over your funds into the solo 401k. The second way is contributions. So contributions, you know, they're based on your business earnings. So some of the money that you're making, it's really, you can put it into the solo 401k. It's going to be based on your salary, how you're paying yourself. What's really great is contributions can be pre-tax, tax deductible, or after-tax, Roth funds. So you funded your solo 401k with rollovers. Now you have business earnings. So you have a substantial amount of money in your solo 401k. Let's say you find a piece of real estate you want to buy. Awesome. You just wire the funds to the closing table. You're under contract, and now your solo 401k owns real estate. So contributions. What's really amazing about this plan is that contributions are, for this year, 2021, $58,000. And if you're over 50, it's $64,500. It's a huge amount. And like I said, so contributions are based on your net compensation. So, you know, if you're an S Corp or a C Corp, it's going to be based on your W-2 wages. If you're a partnership, you have a K-1, you're looking for line 14. If you're an LLC or a sole proprietor, it's your Schedule C, your net, so that's after deductions. So there are two types of contributions in the solo 401k plan. You have employee salary deferrals and employer. So for the employee, it's 100% of your compensation, but it maxes out at $19,500. If you're over 50 years old, you get an extra $6,500 for catch-up. Your employee can be pre-tax or Roth. For the employer contributions, the profit sharing, it's either 20 or 25%, depending on your business structure. This is going to be pre-tax. Pre-tax contributions are made with pre-tax dollars. The great thing about this is that it's tax deductible. So you pay the taxes on the funds. You eventually distribute from the plan. So yeah, you're going to have to pay taxes when you're distributing, but during retirement age, you're typically at, you know, a lower tax rate. So you've got a lot of benefits, you know, before retirement. Now you're at retirement and you're taking distributions, so your taxes are much lower. So should you make pre-tax or Roth contributions? That's a very personal decision. And that could change, you know. Maybe one year you really need to lower your taxes. Right then, you'll want to make pre-tax. Let's say one year, you know, you really want to do Roth because maybe your salary was a little lower. You can handle, you know, not taking that deduction. So this is something you definitely want to work with your CPA, your tax attorney. Those people are going to help you on how you should be making your contributions.
Great. That's awesome. Yeah. So let's dive a little deeper into Roth 401k. Super important topic. A lot of our clients actually come to us and they ask us after they've already opened their plan, can I open up a Roth 401k? Well, the good news is that when you open up your solo 401k with us, it comes with both traditional and Roth buckets. So you can actually fund your Roth right away. So let's talk a little bit about Roth. Basically, Roth started in 2001 with the Economic Growth and Tax Relief Reconciliation Act. Basically, it allowed for these new contributions in terms of Roth, right? So it's the opposite of the pre-tax, right? The money goes in after tax, and then it's forever tax-free. So that's a really huge thing, because you, on the backside in distribution phase, you never have to pay any taxes on the growth or the gains. Again, these are after tax dollars. So just keep in mind, you want to balance it out. Like Ilana said, maybe you want to put some in the pre-tax, some into the Roth. Some people want to do all to Roth. Some people want to do all to pre-tax. Just keep in mind with the Roth, there's no tax deduction going in, but the money will always be forever tax-free when you distribute it on the back end. So one thing also that's nice about this, the solo 401k and the Roth component of the solo 401k is that, unlike with the Roth IRA, there's no income limitation. So with Roth IRAs, if you're above a certain amount of income, you cannot even contribute to a Roth IRA, right? With a solo 401k, the Roth bucket, you can contribute even if you're making $1 million, $2 million. It doesn't matter, right? There's no ceiling for contributions to that Roth 401k. So that's super attractive, especially for those high earners, maybe those that are, making a lot of money in their active real estate business. You can contribute a lot of money to this plan. Like Ilana said, up to $58,000 can go over to that Roth 401k bucket. So just remember too, just like Ilana had said, there's two different types of contributions. There's the employee. Since it's your small business, you wear multiple hats, right? You can be both the employee, you can also be the employer, right? You can give yourself a profit sharing contribution. Just remember that those contributions for the employee side could be either traditional, which is pre-tax, or they could also be Roth. Just keep also in mind that the employer side always has to be traditional. So those are definitely things to keep in mind. But yeah, Roth is a very powerful vehicle. So just diving in a little bit deeper, on the pre-tax side, a Roth for the employee salary deferral, that can be up to 100% of your net compensation or 100% of your W-2. So up to $19,500 if you're under 50, and if you're 50 or older, you get an additional catch-up with another $6,500. So that can be up to $26,000, almost 100% of your compensation. Also, the profit sharing, depending on your business structure, can be between 20 and 25% of your net compensation. On that side, there is no catch-up, but again, that's all tax deductible. Now, with that salary deferral, again, it is $19,500, and it is up to 100% of your net compensation. You can also you can contribute all of that to Roth, that employee side, or you can just contribute a portion of it. You could decide to put just half over in the pre-tax and half into the Roth. It's totally up to you how you want to make those contributions. What's nice is on our website at solo401k.com is we have a handy contribution calculator. You can go there. As you can see here, there's major differences between the solo 401k and the SEP IRA, the simple IRA, profit sharing plans. For any given amount of compensation, you can contribute a lot more to the solo. So in this example, your net income is $120,000. You can get your tax deductible contribution can be up to $49,500 with the solo 401k, as opposed to the SEP, it's only $30,000. So with the Roth, there are limits to what you can contribute. For the employee, just to recap, it's $19,500. If you're 50 or older, there's an additional catch-up, another $6,500, and that makes the total contribution limit for employee side up to $26,000 per year. And that's per participant. So if you do have a spouse that participates in the plan, they can also do that same $26,000 as well. Let's look at a little example. So Tiffany's got a Roth 401k. She's a doctor. She's the only employee of her S corporation. She does pay herself that $120,000 in W-2 wages, which means her total contributions can be that $49,500. Now, how do we break that down, right? There's $19,500 coming from her employee contribution. Then there's $30,000 additionally coming from her as the employer, making that profit sharing contribution. Now, Tiffany decides to elect that her employee contribution be that Roth 401k. So that entire $19,500 as an employee contribution can go directly over to the Roth 401k. She deposits that into the Roth bucket of her trust checking account. And then from there, if Tiffany, for example, is looking for an investment, all she has to do is find an investment. She could obviously find an investment maybe with Cherry Street Investments or another syndication. She could use those funds. All she has to do is just wire the funds directly from that Roth checking account it's just a trust checking account. And all she does is send those over to the deal. Her trust basically just owns those shares of the syndication. She becomes a limited partner. Her trust becomes that limited partner in the syndication. And then, she obviously, once there's a return on the investment, she's completely passive in it. She doesn't have to lift a finger. All of that money that comes back to her gets to grow tax-free. So let's say she maybe wired 100,000 and she made, let's say 25 or 50,000. All of that gain is forever and completely tax-free in her Roth bucket.
Great. Thank you, Eric. Okay, so maybe you don't qualify for a solo 401k. That's okay. We have an option for you. We are not going to leave you hanging. So we have something called a checkbook IRA LLC. It's a great way to get control of your funds and invest in what you want. Just like with the solo 401k, you're the one that's going to direct all of your investments. You're going to choose whether this is traditional or Roth. So we are very hands-on for this. It's a little different than the solo 401k. So what happens is we're actually going to establish a new IRA or Roth IRA account for you. At the same time, we're also forming a special purpose LLC. This is owned by your IRA. It is not a business. The LLC is an asset of your IRA. So it looks like this. We do the rollover for you of your old retirement plan into your new self-directed IRA. From there, you're just going to move your funds into an LLC bank account. We set that all up for you. On that LLC bank account, you're in control. We have no access to that. So you're the one that's going to wire your funds to a deal. So just like with the solo 401k, you'll just wire funds from that bank account to the closing table. You're under contract. And now your IRA, it owns a piece of property or it's in a syndication. You have that free flexibility that the solo 401k has. So once again, what happens is we establish your new IRA, whether it's traditional or Roth. We form that LLC for you. We open up that LLC bank account. We get the funds from that LLC bank account into your control. So then you're going to wire them out to the deal. So very simple, very hands-on, and it's a great option if you don't have a small business. There are plenty of people out there that you just have full-time W-2 jobs. That's okay. You can still invest in real estate. So let's look at the differences between the two, because there are some differences. So for the solo 401k, of course, you need to qualify. So as long as you qualify, great. With the checkbook IRA LLC, everyone qualifies. So everyone here on this call right now, you can all have a checkbook IRA LLC. For the solo 401k, contributions are always based on what you're paying yourself from your business. So if you're not making any money, you cannot make any contributions. For that checkbook IRA LLC, the contributions come from, your earnings for the year. So you could always throw that $6,000 or $7,000 in there. Here's the big difference, the contribution limits. With the solo 401k, it's $58,000. When comparing it to this $6,000, I mean, whenever I'm talking to someone on a call, I'm like, if you can qualify for the solo 401k, do it. There are a lot of, huge advantages. Like I said, it's great that there's also the checkbook IRA LLC, but if you could have some kind of small business, do that. Also with the solo 401k, it could have pre-tax, voluntary after-tax, and Roth funds. With the checkbook IRA, it's only going to be one or the other. A lot of our clients will open up both because they have both traditional funds and Roth, but they'll be two separate accounts. With both of these accounts, of course, you can invest in alternative assets. That's what makes them so great. With the solo, you're going to use your trust name. With the checkbook IRA, you're going to use your LLC name. As for rollovers, almost any other retirement account can roll into the solo 401k except for the Roth IRA. With the checkbook IRA, it depends on what you choose for your tax classification. Is it traditional? Is it Roth? So this is a big one. The solo 401k is exempt from UBIT, from UDFI, unrelated debt finance income. You're going to see that when it comes to syndications and any other leveraged deals. So that's another huge one here. We will talk about it a little bit in a few minutes. The checkbook IRA is subject to this tax. The solo also includes a participant loan. You could actually borrow funds and use it for anything, whether it's to pay down a high credit card, to buy a car, buy a boat, whatever you want to use it for. So you have access to your funds for other things besides investments. You could actually take $50,000 or 50%, whichever is less. There's no loan in that IRA. The solo 401k set up in one business day, really in 2 to 4 hours. So very fast. Few extra days for that checkbook IRA. Much more moving parts there.
Perfect. That's awesome. So let's talk a little bit about one of the investment types that we had mentioned. Obviously, there's a lot of different investment types that you can do. You can do cryptocurrency, real estate, gold and silver. But let's talk a little bit more deeply about syndications as one of the investment types. So syndications, basically, it's where you have an investment sponsor that's raising capital for a syndication deal. Typically, these are large projects, right? They're apartment complexes, mobile home parks, senior assisted living facilities, maybe a self-storage, any kind of probably a commercial property, most likely, because they're larger deal structures, right? And basically what happens in a syndication is that several investors purchase membership shares in an LLC. Typically that LLC then gets a loan to purchase the rest of the property, right? So there might be like a few million of dollars that need to be invested. So every investor is investing a portion of that amount. Otherwise that deal would not be able to be able to happen, right? So those individual investors are participating in that deal. So in the deal, you have a couple different people involved, right? You have the general partner of the syndication. They basically do all the work. They're doing the active management and the setting up of the deal. They raise all the capital. They actually secure the financing. They hire and manage any rehabbing that needs to happen. They maybe actually are part of the team that sells the property. Basically, they're putting in all of the sweat equity, all the time, all the major brain power to figure out the deal, make sure that it's viable, and actually to execute on it. And then you have the limited partners. These are the passive investors, right? They are really just sending funds to the general partner. They're not involved in any of the day-to-day activities. They just actually basically fund the deal with maybe their retirement account, or it could be funds outside of a retirement account. So in putting together the deal, the GP, the general partner, tries to see what kind of returns are going to happen, or is it going to be a profitable deal, right? Maybe they'll choose an apartment complex in their area that's undervalued. Maybe it needs some work. Maybe it needs some improvements, right? So they are raising that money to fix it. Maybe they're going to increase the rents on that property. Maybe they're going to improve vacancies. But either way, ultimately, they're looking to improve cash flow and ultimately improve the valuation of that property over time. Typically, the exits are in like 3 to 5 years. So it is somewhat of a long-term deal structure. But keep in mind that the profits on these deals can be very attractive. So let's go into a little bit of an example deal this is Rama. He's raising capital for his apartment syndication. So he's the general partner, right? His friend Aziz has a solo 401k and wants to invest in Rama's deal. The investment amount for the syndication is $100,000. Let's go ahead and take a look at the numbers, at the deal numbers right away. So basically, Aziz invests $100,000 The total raise is 1.5 million. So essentially that means that Raman needs 15 investors at $100,000 each. And the total funding that he needs is 3.5 million. So he'll have to get financing for the rest of that to make that deal work. So how does that work for Aziz, right? As the solo 401ks, Aziz signs that subscription document using his trust name. His trust name in this case is Kapoor Investments Trust. So Kapoor Investments Trust is on the subscription document. It's the actual investor. Aziz signs the paperwork as the plan trustee. Aziz also is able to wire the funds directly to the investment company from Kapoor Investments Trust bank account. So he has that bank account he set up with the solo 401k. All he has to do is write a check or wire the funds directly to that closing table. And then on the backside, this is the best part. He gets those quarterly distributions paid out. Funds go directly back into his trust checking account. Again, Kapoor Investment Trust bank account that he has set up. And 5 years later, if the syndication has an exit, they have a sale, obviously all that profit, again, flows back into his trust checking account, back into that bank account, right? It stays arm's length. He never touches it personally. So he keeps it in his retirement account. And that way it's all compliant with the IRS and everybody's happy. So what are the best practices really, right? On a syndication, if you are the general partner, you don't want your solo 401k to be invested as the limited partner on the same deal. Also, if your solo 401k is a limited partner it can definitely be a limited partner on other people's deal, just not your own, right? We're going to get into a little bit more about that, about prohibited transactions, but you just want to keep in mind just follow the rules and everything works out in your favor, right? Your solo 401k also cannot be the GP of a deal. So, just keep in mind, you want to keep your active investments in your business outside of your retirement account and your passive investments in your retirement account. And that will, obviously keep you out of any trouble with the IRS. Perfect.
Right.
And then
I'll go over what is UDFI. So UDFI is unrelated debt finance income. So it's triggered when leverage is obtained in a deal. So the tax is applied to the amount of the deal that is borrowed. So like we said earlier when we were comparing, the solo 401k is exempt from UDFI. IRAs are subjected to the UDFI. Syndications obtain leverage. So if you have an IRA, you will have to pay, an additional tax, but don't let that deter you from a deal. It's most likely still worth it. So yes, the solo 401k is exempt. No, the IRA is not, but still it's worth it. So why invest in a syndication? Someone else does the work for you. Just like how we saw the example of Tiffany. She's a doctor, she's busy. She does not have time to, put the effort in. It's a lot of effort. So this is really simple. You're just wiring a check, but you're doing your research and you're making sure you're going with, a trusted group like Cherry Street Investments. So really important to do that research, but you're essentially going to sit back and collect a check. What else is great is it's smaller amounts of money. Instead of having to fork out $300,000 for a property or a large sum, it could be $25,000, $100,000. So that's great. And then of course, you're not dealing with the hassle of tenants, finding the property, all that stuff that could be quite the headache. Also, you do not need real estate experience. So that too is pretty great. Also, you do not carry 100% of the liability. Why use the retirement funds? No capital gains on profit. Gains are all tax deferred or tax free. And remember, no UDFI on leverage if you're using the solo 401k. So prohibited transactions, we touched upon that a little bit. What's really important, if you personally are in a deal, your retirement funds are not. As long as you're the LP on a deal, you're pretty much fine. A lot of prohibited transactions come into play when you do purchase maybe a rental property and the sink's broken. You're not going in there and fixing the sink. Maybe you know how, you can't do that. You need to have that arm's length. So be careful of prohibited transactions. So about us. So we are your IRS approved document provider. but we are here to educate you. You know, the big shining star about our company, I think, is our support team. We just have such a great support team. You could speak to us on the phone. I think a lot of companies don't take phone calls. You can chat with us on our website. It's a human being you're talking to. You could email us. So we try to supply as much support as possible because it's fully self-directed. So you do have more responsibilities. So we want to be there for you. We've been doing this for a very, very long time, for the longest. So for 15 years. So we have lots of great experience. So our setup fee is $3.99. Our annual fee is $99. We do collect both up front. So it's $4.98 your first year. Every year after that, just $99. They're all flat fees. The checkbook IRA LLC is a little more expensive just because we're doing a lot more of the work. So the setup fee is $9.95. The annual fee is $3.25, but that's it. So every single thing is included in those fees. Here's our information. I'll leave this up here for a second. If anyone wants a one-on-one with Eric or I, we'd be happy to go over your situation. You could always call us, email us, and we can get you on the schedule as well.
Thank you so much, Ilana. That was great. Thank you so much, Eric, for sharing all that information. I think we have some questions. We can go over that. While we are doing that, I just wanted to quickly share a link that these guys have given for, I think it's a $50 discount if you use them for Cherry Street. So if you guys are interested, you can follow the link and get the discount on the setup for both solo as well as checkbook IRA, right? Mm-hmm. Ilana?
Oh, yes, for both.
That's right.
For both. Yep. I don't know if it takes you only to the solo setup. I'm not sure. I didn't try the link. So
if it doesn't, we'll make sure just email us and let us know that you're with Kavita's group, and we'll make sure that we get you that discount. So don't miss out on your discount.
Awesome. Thank you. All right, let's go through some questions here. So Renipa asked, can a husband and wife who own an S Corp together roll over their IRAs into a single solo 401k?
Yeah, that's a great question. Yes, and that's one of the advantages. You can invest together in deals. Yeah, but you're right. If as long as that you and your spouse do receive some form of compensation from the S corporation, then yes, you can definitely have your spouse on the plan as well. And then they could roll over any traditional IRAs, any old 401ks, so 457, 403bs. Yeah, they can roll their funds in as well. You will want to keep those accounts separate in your solo because they are still technically, you're both individual participants in the plan. But yes, it's 100% possible. We do that all the time for clients.
So they are, let me understand this. If let's say she has a IRA, he has an IRA, they can combine it into a single solo. It remains in two different solo accounts, but attached to the same company. Is that right?
Right. There's the one sponsoring business. So it's important just to note that with a solo 401k, the business is the sponsor, and then you have participants, right? So if say, for example, the husband and wife both get compensation from that business, then they can both be participants in the plan, right? So, but you just want to keep track of those contributions that you make for each person, because those are still just individual participants. It's one set of plan documents, so you only have to pay that one fee to set up the solo 401k, but you just want to keep those individual accounts. You might want to have, like, for example, a trust checking account in the name, of the husband, and then a trust checking account in the name of the wife. That way you keep those funds just for your own accounting purposes separate.
Can they both invest into the same deal as a single entity? There are two entities here, or so let's say I have something trust, right? XYZ trust. Are they both XYZ trust, or are they XYZ name trust? I mean, like, meaning they have their own different trusts. I'm trying to understand that. From
yeah.
an entity standpoint, are they different entities?
It's just one entity. So
Yep.
You're always using the same trust name. The reason why you just want to have the separate bank accounts, because it's much easier on you as you're the plan administrator. You're keeping good detailed records, especially upon distributions. you might be taking distributions at a different age than your spouse. Also, you need to be taking your own funds. So it's just one plan. Having it separate, it's a recommendation, a huge recommendation. And it's just one plan. And you could absolutely invest on deals together. You know, one person will wire the funds from their account, one from the other, and you could absolutely go in on the same deal. So yeah, that's a great question. And it can seem complicated, but it's one plan.
That's good to know. I know people will come ask me these kind of questions. So as a sponsor, on the sponsor side, these are things that I just got tripped up today because I misinformed someone that they could roll a Roth IRA over. They were like, no, I can't. We spoke to Nabers. And I'm like, oops, sorry. So there he is. He's on the call actually. So Melinda asks, is a 57 or 58K limit for the solo account, or is it a limit for all contributions, including your workplace 401K included in that 58K?
Yeah, so that's a great question. So $58,000, you could actually contribute the full amount to your solo 401K, but you have to utilize a strategy called voluntary after tax if you're going to do that, because your employee contribution, it is for all of your 401Ks, whether it's your workplace or the solo 401K. So that's where, if you're doing $19,500 to your workplace, you cannot do the $19,500 to your solo 401K. But there's a way around it, and it's called voluntary after-tax contributions. It's a complex strategy. We have a lot of resources, on our website. We've done some webinars about it. So you can get to that max. There is a way.
Awesome. Okay. We'll have to look that up on their website there. Wei asked, I have both the W-2 job and my own S Corp that I do consulting work. If I already contribute the employee portion of 19.5 offered by my employer, can I still contribute the employer portion of the W-2 income from my own S Corp into my solo 401K?
Yeah, that's exactly right. So you can, like Ilana was saying, the employee side is limited across all 401K plans, but the profit sharing portion is not. So you could have your job, your W-2, where you're working for some company and contributing there as an employee, and then you could also have your solo 401K over here and do that profit sharing contribution, and then you could also do the voluntary after-tax contribution like Ilana was saying. So yeah, you can still even fully max out on the solo, even though you're already doing that employee contribution at your job. Just keep in mind, it just can't be the employee contribution over here. It just has to be the employer or the voluntary after-tax contribution.
Any follow-up questions, feel free to type that in. All right, Ram asks, what is the difference between a self-directed IRA and a solo 401K?
So we did go over that, so you can check back at the slides. There's a great little comparison. But
we have a little table there.
Maybe. It's a great table. The main difference is you have to qualify for the solo 401K. Everyone qualifies for the self-directed IRA. So if you qualify for the solo 401K, go for that. If not, great. We have a self-directed IRA.
Awesome. I think the biggest difference that I found was the whole, one of the things, right? Like personally, I paid a lot of fees with self-directed IRAs, and I didn't know about your checkbook IRAs. That's something which was new to me, because normally you need a custodian for a self-directed IRA. Right? There are a lot of self-directed IRA companies. They always need a custodian. So I ended up having those custodians. And I was telling an investor today is that you end up paying per asset, or you end up paying really high fees for a self-directed IRA, besides having to deal with UDFI, right? Mm-hmm. So for me, solo 401K, if you can qualify for it, that's a slam dunk. I mean, don't bother paying every quarter fees for a solo self-directed IRA. And then also you are at the mercy of the custodian for them to do your documents. And I deal with investors all the time, right? Some investors have a self-directed IRA, some have a solo 401K. The solo 401K, just like them writing a check or wiring the funds like from their cash account, whereas the self-directed IRA is dealing with this whole IRA company and going through the whole process. And I like that you guys have this checkbook IRA, because that makes things a lot simpler from a passive investor standpoint, right? Just cut out a check or wire the funds. That's something I wasn't aware of until today. So
yeah, no, thank you for sharing your experience with that, because we hear that a lot from people that are on a custodian plan, and it's, they can't even get to a deal that fast because they have to jump through so many hoops and then transactions.
I have lost
and
deals.
that.
I have lost deals as a passive where I couldn't get things done in time, right, for the deal to fund. And there were so many delays on the funding side because of the custodian. So this happens all the time. So if you can qualify for a solo 401k, and Ram, I know you do because you have a business, do a solo 401k. That's my advice.
Good advice.
Right.
Good advice for sure.
Are there any annual expenses fees for maintaining the solo? I think you already mentioned that. That's $99 a year. When we funded the syndication, we did that from a self-directed IRA. Now we want to avoid UDFI. Can we roll over a self-directed IRA into a single solo 401k? Yes.
You can. Yeah, you're going to have to work with maybe your CPA or the deal sponsor to get those assets retitled into the name of the solo 401k trust. But yeah, it's definitely possible to do that, to move that deal over for sure.
I know which deal she's talking about because so yes, please, I'll send you a retitling document. You can retitle that asset. It's selling soon, so hurry up. All right. What is covered in the annual maintenance fees for the trust and LLC respectively? I think that they're talking about the checkbook.
Yep.
Yeah. It covers everything. You're never going to see more fees from us. That's just that. It's flat fees.
And is there a setup that $995 includes the LLC setup as well initially, right?
Everything. Yep.
Okay. All right, Melinda asks, can two different sole proprietorship owned by the same individual share a solo 401k or same Roth IRA LLC?
So two people, like if you have a sole proprietorship, like you and your spouse, or if if you have two businesses, you can be on the same solo 401k. That's okay. As for a Roth IRA LLC, an IRA is for the individual only. So you and your spouse, it's always going to be separate. So that's a great question. So yes to the solo 401k. With the IRA, it's just for the individual.
So if you have, it doesn't matter how many businesses you have, you just contribute to the Roth IRA as an individual. So if your spouse has their own Roth IRA, then there's no commingling there, right? All right. Can you do a backdoor Roth? Of course, I guess so. But that's another whole discussion, right? Backdoor Roth. So actually have a webinar on that. If you guys want to check it out on my YouTube portal, we have a webinar on backdoor Roth. So that's an hour's discussion in itself. So we won't talk about that today. Can you give an estimate of how much UDFI will be for a 100K investment, say with 15% IRR over 5 years?
Late to do math right now.
Yeah.
With this, right? It depends on the amount of leverage, right?
Exactly.
It depends on the amount of leverage because you are taxed on the levered portion of the gain. So you'll have to figure out what the leverage was, what your investor amount was, total amount from all the investors, and what your ownership share was based on that. So the math is not going to be as simple as what you asked us to do on the call. So sorry about that. Not a question, but just a comment. Eric from Nabers answered my complicated questions earlier today over the phone, and I really felt your team is committed to helping your clients with a human touch rather than pre-recorded answers or transferring from one department to another. Please keep it with this way, smiley face.
That's awesome. Whoever that was, hey, thank you.
That was Melinda. I just sent him there today. So.
Oh yeah, he was great. Yeah, I really liked it. Enjoyed talking to him.
Can we share the slides later? Is that possible? Maybe a PDF copy or?
Yeah, we can. I'm pretty sure we can share the slides, right? Yeah.
Mm-hmm. Yeah, and also remember all these webinars will be recorded, so you can go back and revisit it and actually not just see the slides, but actually have listen to what they have to say about it. So All right. If we already have a solo 401k trust formed with another company, I asked this question, so thank you. Before our call, I asked this question because I have the worst time with this provider. Formed with another company, can we have the same move to you for annual maintenance? Absolutely, yes. The answer is yes. And I'm in the process. I'm going to do this too because I find that this is much better than what I have right now. I don't have any call-in support. I have to just email. So, all right. I think we've gotten through all the questions. So, folks, if you have any other questions, their support team is here to help. So, thank you again, Eric and Ilana, for being here tonight. I appreciate you sharing this information and hope this was useful for all of you guys. 2 weeks from now, we have tax planning for passive investors with Brandon Hall, who's a CPA. So, I hope you guys can join us. As always, thank you guys for taking time away in the evenings to come learn with us and join experts like Ilana and Eric. I appreciate all your time, both the speakers and the audience, for being here tonight. Thank you.
Thank you also.
Thank you for having us. We appreciate it.
Hi, I'm Kavita Bartake. I hope you found this video useful, and if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.